It's Brian Preston, the money guy.
This is from Richard, and it ties in with the show that we just did really well. Can you guys go over deciding on a retirement age and the differences retirement age has on finances? I even saw one of the guys in the chat, because I kind of read it while we're going through. He said, hey guys, you talk about financial freedom. I teach 20-year-olds, and they just care about time freedom. That's what they're worried. They want their time freedom. Let's talk a little bit about, especially in the context of like the FIRE movement and retirement ages, what are some of the things you ought to think about when you're selecting when you want to retire and some of the financial implications associated with that?
Man, that's such a we could do a show on that, but I will try to keep it somewhat brief and tell you. The first thing I would say is you have to know who you're going to be when you grow up. Mm-hmm. I mean, that's why when I hear people say they want to retire in their 30s and 40s, and please don't misread this, but it makes me wonder: are you even doing have you found what you're supposed to be doing on this planet? Because at 30s and 40s, you're just getting cranked up. We already know your peak earning years are in your late 40s to early 50s. Yep. So if you're already trying to retire at 30 and 40, that's the first thing: is have you figured out your why on that side? But on the side of finances, I always think it's when I'm in my 30s and 40s. You don't know how many kids you're going to end up with, because that's the thing. We've seen that with a lot of famous fire folks that retired in their 30s. They're like, holy cow, I had no idea daycare and education was going to consume this much of my resources. So make sure you have all those variables. It's easier when you're in your 50s, 60s, and 70s. The kids are out of the house, so life, you've kind of adjusted to where you're going to live. What type of cars you're going to drive, what type of house you're going to live in. But when you're in your 30s and 40s, there's a lot of variables that you just don't know about.
Can I throw one out that I've seen like in real-time practice? Let's say that you're someone who's part of the FIRE movement and you want to leave the workforce early and you're planning on, living in Sheboygan, Wisconsin. I've never been there. It might be a really nice place. It's just first thing that comes ahead. And you live there in retirement. Like, what? I want to move to San Francisco. Or I want to go live on the coast. Well, your FIRE plan might have worked really, really well for the community in which you started your retirement or your financial independence. If you want to go move later in life or go somewhere else, and that somewhere else has a higher cost of living, it can blow up the whole plan. So that's kind of something, you said it perfectly. I think you said in your 30s and early 40s, you don't know what you don't know. And so it's really hard to plan for the next 70 years with all of those unknowns at play.
Well, then fast forward to your 50s. I mean, healthcare is always an issue. Yep. That's something that we see constantly and look, the Affordable Care Act looked to address some of that, but it's still not perfect either, because a lot of, I know even here in Tennessee, we had trouble finding insurance companies that wanted to be on the exchange.
Yep,
so it still creates a lot of healthcare problems. If I could ever nudge Washington to work on something, healthcare and access to it would obviously be something that you would love to see a little more bipartisan support on, because it is a struggle to figure out, even if you have enough financial assets, how do you ensure that you're going to be okay with your health care until you reach the age of 65 and eligible for Medicare? That's always a strong concern. And then, of course, through all of this will the dollars make it through to the finish line? Meaning that when you check out, when you leave this planet, did your money actually last? And that's why we always talk about safe withdrawal rates. Now look, when you do a full retirement plan, it goes well beyond safe withdrawal rates. I still want you to know safe withdrawal rates, in my eyes, is still napkin planning. It's great napkin planning, but it's still not, it's something you do when you're 5 years out and beyond. It's not something you do when you say, hey, yeah, I'm retiring next month. It's all right. I've got a safe withdrawal rate that should handle it. That scares me, but I can give you the guidance. Bo and I were talking about this, and we actually differed, is that I think that if I was given some guidelines, I think somebody who's retiring in their 70s, you'll see why I'm starting at the 70s, you can have a safe withdrawal rate of around 6%. Okay. Somebody who is 60 and between 60 and 70, you can go with a 5% safe withdrawal rate. I think somebody who's under 60, but kind of that 50 to 60 range, there's your traditional. It changes between 4 to 4.5% in there, and then anybody who thinks that they're retiring 50 and below earlier, but then 50. That's why we're always talking about a 3.5% safe withdrawal rate, is because, guys, there's just so much life that you need to adjust those numbers. Now, when we kind of have had previous discussions on this. Were your numbers different?
No, you know what? Hearing you say it, I don't disagree with you. The one thing that, I am okay with a slightly higher withdrawal rate later in life than you said, but yours makes more sense because it's a more conservative posture. Because again, your biggest risk is you don't want to outlive your money. So keeping that withdrawal rate. And what we find with a lot of our clients is we start retirement with one income goal. Well, if the markets perform well and the accounts do well, or maybe spending is lower, or I don't know, maybe there's like a global pandemic that shuts the world down where you can't travel. So all of a sudden the $10,000 you were plan on spending on travel didn't get spent. You can allow each year to be a little dynamic as you move through financial independence, so long as you recognize there are times that you can loosen your belt and times that you have to tighten your belt. I think you can set yourself up for long-term success.